Now, when that enormous mountain of credit becomes unstable, I mean, what do? You get out of credit and go into money. And that's basically what's happening. It's beginning. And I think this is the key thing. And of course, so few people understand it because they think the gold price is rising when it's not. It's the credit declining. So we're looking at about 128, 130 trillion dollars of credit, currency and credit, which nobody's going to want. So what happens to its value? It goes, I'm afraid. And that's why, incidentally, the gold price is looking remarkably strong. It's not that gold's going up. It's just that foreigners would rather have gold than dollars.
The surge in gold prices reflects a broader trend in the world's gold market, driven by escalating bets for US monetary easing and gold's allure as a safe haven asset amid growing global uncertainty. Investors, grappling with mounting anxieties, are flocking to safe haven assets, underlining the significance of their concerns. Gold prices have surged by over 11% this year, buoyed by robust central bank buying and heightened demand for safe haven investments. Alasdair Macleod highlights the reason behind the recent spike in gold prices, attributing it to an increase in gold's value and a decline in credit value. With the precarious state of the credit market, investors are turning to the stability of gold, signaling a gradual shift from credit to tangible assets. Commodities priced in gold terms exhibit remarkable stability over time, contrasting with their volatility when priced in fiat currency. The simultaneous rise in commodity prices underscores this flight from credit to tangible assets. Amidst growing concerns about the resilience of the global financial system, the prospect of a US interest rate cut looms large. The US Federal Reserve, having hiked its benchmark interest rate to a 23-year high to curb inflation, faces mounting pressure to instigate monetary easing. Alasdair underscores the increasing visibility of higher inflation rates, often concealed by government statistics, and highlights the historical precedent of US monetary easing preceding global financial crises. The intertwining of long-term and short-term issues, compounded by accumulating risk factors, paints a precarious picture. Against this backdrop, as foreign investors holding substantial credit-based assets seek refuge in safer havens, rising interest rates could exacerbate this flight. This transition, driven by a loss of confidence in credit and exacerbated by rising inflation and interest rates, will have far-reaching implications for the global economy. We will present clips from Alasdair Macleod's interview with WT Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The only real money, and has been since Roman times, is gold. Physical gold, not paper gold or anything like that. The real stuff. There is no counterparty risk. Everything else is credit. Even equities are credit. Why is an equity a credit? I mean, you think you own an equity. For a start, you own. You don't actually own shares anymore. You owe an entitlement, which may or may not be delivered. But the basics behind owning an equity is that you're buying into the promise of an income stream. And it's that ultimately gives the value to the equity. So everything else is credit, other than gold, other than physical gold. Now, when that enormous mountain of credit becomes unstable, I mean, what do? You get out of credit and go into money. And that's basically what's happening. It's beginning. And I think this is the key thing. And of course, so few people understand it because they think the gold price is rising when it's not. It's the credit declining. And of course, it'll take time before, all the sort of statistics which everybody loves, macroeconomic statistics sort of reflect this. But you'll find that in time, other things will sort of come in line and confirm that is indeed the case, like its purchasing power in terms of goods and services. And as I said earlier, we're already seeing this with commodities. If you look at the value of a basket of commodities over a long period of time, it's remarkably stable priced in gold. It's when you price it in fiat currency that it's volatile and tending to rise over a long period of time. And now we are seeing commodity prices rising. Gold is going with that flow. Whether it's driving it or not is not the material point. The point is that people are getting out of credit into something solid. which is in the case of the Asian hegemons, is basically commodities. They're investing in commodities. They're stockpiling commodities. China is stockpiling copper. She has been stockpiling silver for a long time, though she's lost control of the pricing, and we're seeing that actually happening at the moment. Russia and all the rest of them are supplying energy, and we're trying to deny that this energy has any value. We're saying it's nasty stuff, but we can't do without it. As I said earlier, WTI has gone from 68, 69, it's now 85. This has an effect. So what you are seeing is you will see this come through in higher rates of inflation, which is a joke. CPI inflation rate is something which is made up by governments. It suppresses really what's going on. But anyway, we'll put that argument aside. The fact of the matter is credit is losing value. And when people actually understand this, they will run for the doors. They will get out of credit wholesale. And it'll start with the foreigners. It usually does. Foreigners who hold on to someone else's currency for whatever reason. I mean, the case of owning equities, I think they've got about 14.5 trillion in equities, in US equities. That is a speculation. I mean, that is all it is. You can dress it up and say that this is international diversification, portfolio diversity. It's speculation. And the moment that goes wrong, what will the foreigners do? They'll just get the hell out, save what they can. And rising interest rates will trigger that. I think we are actually in the early stages of a major shift in value for the whole of the credit complex.
The dominance of the US dollar and its status as a global superpower are teetering on the edge amidst internal uncertainties, global fragmentation, and the weaponization of the American currency. While the US dollar might appear formidable on the surface, underlying vulnerabilities could destabilize its power. Alasdair points out that much of the US economy relies on government spending, financed by increasing debt issuance. This strategy artificially inflates GDP, masking structural weaknesses, exacerbated by excessive regulation and unproductive spending. The looming prospect of rising interest rates threatens to expose these vulnerabilities, particularly in sectors like commercial real estate and private equity, which are rife with risky investments. However, despite these weaknesses, the absence of a strong contender to challenge the US economy has bolstered the dollar's resilience. While China is often seen as a potential rival, its own economic challenges hinder its ability to surpass the US. Nevertheless, the inherent instability of the US dollar, driven by mounting debt and over-leveraging, poses a significant risk. Wary of this instability, foreign investors may seek refuge in tangible assets like gold, thus contributing to the ongoing strength in gold prices. Let's get back to Alasdair's interview.
I think it's the sheer power of America on the global stage. I mean, nobody would say boo to a goose, because they know that if they criticize America, then they're likely to have a regime change. And the existing regime is not going to want that. So, they just keep quiet. And that this actually describes virtually the whole world. America and her allies, as it were, their population numbers just over 1 billion. I think I worked it out the other day, about 1.12 billion on official figures anyway. But that is out of a total of 8 billion. If you look at the Shanghai Cooperation Organization membership plus BRICS, that's 60% of the world's population. I mean, we are in a small minority, and the rest of the world is industrializing quite rapidly. The rest of the world is moving on, leaving us behind, and it's not going to want our currencies either. If you look at the US, a lot of the economy is just hot air. It's hot air because the government is spending, on my estimates, somewhere between 3 and 3.5 trillion, which it is funding out of thin air. Unless you see, a significant increase in personal savings in the US, which we're not, it's going the other way, then the GDP is being bolstered by this. The idea that the economy is resilient is hogwash. It's not resilient at all. The only reason GDP is holding up is because the government is spending like a drunken sailor and not productively. I mean, people do confuse a progression, economic progress with GDP. GDP is just, all it does is it measures the value of the transactions. It doesn't tell you what the quality of those transactions are at all. So the US economy underlying this, when you allow for all this government spending and excessive regulation and everything else that the government throws at the economy is actually in a pretty poor state. And not only that, it's over leveraged. We will see interest rates rise, and that's going to expose a lot of malinvestments. We already see this with the commercial real estate side. We see this with the private equity business, which basically, buys steady income stream and then leverages it up. That's now coming up for refinancing. I mean, in England, we've got Thames Water, which is an absolute classic case of this. Higher interest rates are here to stay because of what interest rates do. Interest rates compensate foreigners for the risk of holding a foreign currency, i.e. dollars. And, unless you give them the compensation, they're not going to hold it. They'll sell it. And they've got 32 trillion in financial securities and bank deposits. There's an additional 10 trillion offshore in the euro dollar market. And then there is all the dollars, if you like, which intermediate in foreign currency transactions. I mean, for example, if you sell euro and buy yen, you sell euro, buy dollars, sell dollars, buy yen. So the dollar is always in the middle, and that is estimated by the Bank of International Settlements to be a further 85 trillion. So we're looking at about 130 trillion dollars of credit, currency and credit, which nobody's going to want. So what happens to its value? It, goes, I'm afraid. And that's why, incidentally, the gold price is looking remarkably strong. It's not that gold's going up. It's just that foreigners would rather have gold than dollars.
Gold's bullish momentum is expected to continue after registering strong gains early in the week and hitting a new record high above $2,300 on Friday. The upcoming US inflation data will likely influence market expectations regarding the Federal Reserve's interest rate outlook, further impacting gold's valuation. With gold prices soaring and foreign central banks increasingly interested in the metal, it remains a favored hedge against uncertain monetary policy and global economic conditions. What are your thoughts on the future price movement of gold? Do tell us in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.